Let's start with a single moment that probably haunts you. Price is grinding lower, and then it breaks clean below an obvious low. A low that everyone watching this market can see. And right here, in this exact candle, one of two completely opposite things is about to happen. Either price keeps falling and runs for miles without you, or it snaps straight back up and reverses. Same break, same candle, opposite outcomes. The entire game is right here, telling these two apart before it's obvious. So if you keep getting wicked out at the lows, right before price turns around and goes your way, I need you to hear this clearly. It is not luck. It is not random. And it is not some conspiracy aimed at you personally. It is one specific event, and it leaves a signature you can learn to read. Here's the version you have lived. You did everything right. You found support, you went long, and you tucked your stop just under the obvious low, exactly where the textbooks tell you to. Then price stabbed straight through your stop, took you out, and immediately reversed and ran in your direction without you on board. And here's where it turns dangerous. After this happens a few times, you draw the worst possible lesson. You decide that stops are the problem. So you start pulling them or widening them to avoid getting hunted. And that works right up until the one trade that never comes back. That single trade with no stop is how accounts actually die. So let's reframe the whole thing. Nobody is hunting your stop. Your stop, specifically, is invisible. The truth is simpler and a little more uncomfortable. Your stop is just sitting in a crowd. Because here's what is actually happening. Stops pile up in the same few obvious places, just under the swing low, just beyond the round number, right where everyone was taught to put them. And this is not a guess. When researchers examined real currency order books, they found orders clustering heavily at the round number price levels again and again. And it is not just stops resting there. The liquidity itself is genuinely deepest at those obvious levels. When researchers mapped where the real orders sit in the book, the support and resistance lines that everyone draws lined up with the thickest liquidity on the whole chart. The obvious level is not just obvious to you, it is where the real money is parked. Now connect those two facts, because this is the part that changes how you see everything. A large player who needs to fill a big order cannot do it at the current price. There simply are not enough orders sitting there. The only place deep enough to fill them is that pool of resting liquidity. So price gets pulled toward the pool, and your stop, sitting inside that pool, is the liquidity. And here's the part almost nobody connects. The exact same clustering that makes a support level hold is what later gets it hunted. A level holding and a level getting swept are not opposites. They are two sides of the same pile of orders. Support, resistance, and stop hunts are all the same thing, a pool of liquidity. So when price finally reaches that pool, exactly one of two things happens. Either it is a run or it is a sweep. And here is the cruel part. For the first candle or two, they look completely identical. That is why you keep confusing them in the moment. Let's take them one at a time. A run is real continuation. Price breaks the level, and the stops that get triggered there do not stop the move, they fuel it. Each triggered stop becomes a market order that pushes price further, which trips the next cluster of stops, which pushes it further again. Researchers even have a name for this, a stop-loss cascade. The move feeds on itself, price closes far beyond the level, and it simply keeps going. A sweep is the opposite. Price stabs through the level, grabs all of that resting liquidity in one move, and the big order finally gets filled. But once the pool is emptied, there is nothing left to push price any further. The fuel is gone. So price does the thing that feels impossible in the moment. It reverses and closes right back inside the range it just broke. So how do you actually tell them apart while it is happening?
A sweep leaves a very specific signature. A wick pushing beyond the level, a close back inside, a spike in volume that immediately fades, and no follow-through on the next candle. A run is the mirror image. It closes beyond the level, it holds there, and the volume stays elevated as the move continues. Let's put it together on one real-looking sequence so you can see it the way you would see it live. Price rallies up into yesterday's high, a level the whole market is watching. It pushes 2 ticks above the high, just enough to trip every stop resting above it. Volume explodes on that one candle, and then it immediately dries up. The very next candle closes back below the high. There is no follow-through and no continuation. That, right there, is a sweep. And now you can call it in real time instead of explaining it to yourself afterward. So step 1 happens before the session even starts. You build a map of the pools. Mark the prior day's high and low. Mark the obvious equal highs and equal lows. Mark the round numbers and the opening range high and low. These are the spots where the liquidity sits, which means these are the spots where sweeps happen. You are not predicting anything. You are just marking where the crowd already is. And step 2 is the rule itself, the one I want you to screenshot and keep. A sweep is confirmed when 4 things line up. Price pierces the level. It closes back inside within 1 to 2 bars. Volume spikes on the stab and then fades, and there is no follow-through after. And if you want it as one precise testable line, the wick pushes beyond the level by at least half the average range. Price closes back inside within 2 bars, on above average volume, with no continuation. That is a rule you can check by eye or even code straight into an indicator. Now the honest part, because you deserve the truth and not a fantasy. You cannot completely avoid sweeps. Your stop belongs at the level where your idea is actually proven wrong, and that level is the pool. You cannot outplace the entire crowd. What you can do is read them. Stop confusing a run for a sweep, and stop yanking your stops in a panic just because price reached for a pool you already knew was there. And this is why the videos screaming that smart money is personally hunting you are getting it wrong. There is no vendetta. It is order clustering and liquidity seeking. Boring, documented market mechanics. You were never a victim. You were simply predictable. And the moment you can read the signature, predictable turns into readable. And just so you know, none of this is something I invented. Here is where it actually comes from. The published research behind everything we just walked through. So here is what I will leave you with. Reading the market well was never about catching every trick. It is about understanding one real mechanism at a time, until the chart stops feeling random. If this gave you a cleaner way to see it, subscribe, because that is exactly what we do here every single week. Tell me in the comments about the last time you got swept. Now that you know the signature, you will catch it. And the full pool mapping checklist is waiting for you down in the description.